Hi, let's start with the concept capsules. The topic that we're going to cover today is beta and CAPM. Now, some people like to call it the CAPM, some people like to call it CAPM. You decide whatever you want to call it. It's after all the capital asset pricing model. So what we're going to look into is how do we calculate beta? How do we define beta? What beta is and what it isn't? Because that's also a very important thing, because a lot of people tend to confuse what beta is all about really. Then we take that concept and we develop it into the CAPM model, where we look at the assumptions of CAPM and then how to calculate the expected return based on the beta and the CAPM model. All right, now first of all, what is beta all about? Now, beta is a measure of systematic risk. And what is systematic risk? It is that part of the total risk that you cannot diversify away. So it's the undiversifiable risk. Now, what do we really mean by this? Now, this basically means that it does not matter how many assets or how many securities you keep adding into the portfolio. This is the risk that you just cannot get rid of. So the market is going to reward you for the systematic risk that you're taking and not for the total risk that you're taking. So there's no reason for the market to give you extra return for the risk that you could have got rid of, which basically means the diversifiable risk. Now, one thing that we need to keep in mind about beta, and that's a very popular misconception, is that beta is not actually the degree of correlation between the asset and the market. That's a definition which a lot of people end up giving, but that's actually not true. However, it does depend upon this correlation. So we'll come to that calculation and we'll see how the correlation plays a part in calculating beta. Now first, let's look at the formula. Now that's your formula for beta for a company I. So beta is equal to the covariance between the asset and the market divided by the variance of the market. So I represents your stock, it represents the asset that you're holding. M represents the market. So we usually take any of the popular proxies for the market, typically a popular index such as the S&P 500. So what is the covariance between the returns of I and M? So for instance, if you're taking Apple as, in the example of the stock that we want in our portfolio. So what's the covariance between the returns of the Apple stock and the market? Let's say S&P 500. We divide that by the variance of the market. Now, this is something that we can further simplify. How do we simplify? By looking at what we have in the numerator. We have the covariance in the numerator. Can we simplify this further? We can actually put correlation here. Now, for that, we will need to remember the relationship between correlation and covariance so that we are able to substitute the numerator with the correlation. So covariance between the asset and the market divided by variance of the market is your first formula for calculating the beta of any stock. Now let's look at the relationship. Now recall from quants, how can we expand the covariance term? And what is the relationship between covariance and correlation? Now when you expand covariance, you essentially get correlation between the two things that you're considering, in our case, the asset and the market, multiplied with the individual standard deviations. So this is what you get. The covariance is equal to the correlation between I and M into the standard deviation of I into the standard deviation of M. Now this is what we put into the numerator of the formula that we just saw. So you get this. We have substituted the numerator, covariance between I and M, with the expanded version of that formula. The denominator, of course, remains the same. Now, do you see something common in the numerator and the denominator? We have the standard deviation of the market in the numerator and we have the variance of the market in the denominator. And we know variance is nothing but the standard deviation squared. So you can actually cancel this out. So we can cancel this and this. And what are we left with? We end up getting this. You have the correlation between the asset and the market multiplied with the standard deviation of the asset divided by the standard deviation of the market. So that is the second formula that you can remember. So if you want, you can remember both the versions, or if you are comfortable with remembering the expanded formula for covariance, then you can just do it on the spot. So completely depends upon you. All right, so that was about the calculation of beta. More importantly, how do we interpret beta? Remember, we said that correlation is something that is used to calculate the beta. But beta itself, or beta per se, is not the correlation. So don't confuse both the terms. A common reason why this confusion arises is because of how we tend to interpret beta. So rather than thinking of beta as a correlation, you should actually be thinking of it as a multiplier. Now, how do we do this? Let's say if your beta is 2. The way you can think about it is that if your underlying stock index was to go up by 10%, your asset or your stock will go up by twice that amount. So if that is your underlying index goes up by 10%, your stock is going up by twice of that, that is 20%. So it's essentially a multiplier. Similarly, if your beta was 1.5, that means your asset or your stock is going to move 50% more than the underlying index. Similarly, if your beta was negative, for instance, if it was -2, that means that if your underlying index was to go up by 10%, your stock is going to move twice of that, but in the opposite direction because it's a negative sign that you have. So it's simply a multiplier. Whatever is the change in the underlying index, simply multiply it with the beta that you have, and that is going to give you the extent of the movement in the asset that you are looking at. Now, what do you do if your beta is 0? What does that really mean? That effectively means that there's no relation between the two, because whatever happens to your underlying index, it's not affecting the stock at all. So that's essentially a 0 beta. How about if you have a beta of 1? What does that really mean? And when do you really have a beta of 1? You would typically see a beta of 1 in instruments such as ETFs. Why? So let's say if you have an ETF on the S&P 500 and you're comparing it to S&P 500, you would expect the movement to be very, very similar. So the beta would tend to be very close to 1, if not exactly 1, because of course ETF and your underlying index is not going to have, it's not going to move completely in sync, because of course there are many more factors to consider in an ETF. So the beta would tend to be close to 1 in that case, which effectively means that your instrument moves exactly like the market. So think of beta as the multiplier and not the correlation. Whatever is the movement in the underlying index, multiply the beta with that and you get the movement in your stock or the asset. So that's a multiplier. So that's how we interpret beta. Now let's try out a question on how to calculate the beta. So here we have been given the correlation between the asset and the market, and that is equal to 0.6. Now the standard deviation of the asset is 18% and the standard deviation of the market is 14%. Now what is the beta of the asset? Now here we can apply the second version of the formula that we just did, because we have been given the correlation. Had you been given the covariance, then you could have used the first version that we did. Since we've been given the correlation, we use the second version. What is the second version? We take the correlation, we multiply it with the standard deviation of the asset, and we divide by the standard deviation of the market. So in this case, the correlation is 0.6. So we take 0.6, we multiply it with sigma I, which is the standard deviation of the asset, and that is 18%. So we multiply that with 18%, and we divide that by standard deviation of the market, that is 14%. So that's going to be your answer. So 0.6 into 0.18 divided by 0.14, and that gives you 0.77. So the correct answer is A. So that's how we calculate the beta. Now moving on to the main model, which is the capital asset pricing model, or in short, the CAPM. Now in portfolio theory, this is one of the most important formulas. In fact, not just in portfolio theory, but in finance generally, this is one of the most important formulas that you could ever do. Now what we have to understand is that this formula is not a perfect formula. And in reality, no formula is perfect. If you had one perfect formula, then we would not need to do so many different models. Okay. All right. Now, what is CAPM all about? The essence of CAPM is that it gives us a very simple relationship between the expected return on an asset and the beta of the asset. But CAPM has a lot of different assumptions, and most of these assumptions become the drawback of the model as well. And in fact, when we're done with the assumptions, you'll see that most of them are quite impractical. You can't expect them to hold in reality. So let's go through these assumptions. And remember, these assumptions are quite testable for the exam. So you always need to know, you always need to remember what these assumptions are. So let's have a look at this. The first assumption is that there are no transaction costs. That means that you're not paying any kind of brokerage. There are no other kind of frictions, any other kind of costs involved in trading. Of course, in reality, that cannot hold true. Without brokerage, you will not be able to execute a trade. Then there are no taxes. Now, a world with no taxes, wouldn't that be a perfect world, right? But in reality, unfortunately, this assumption does not hold true as well. And then assets are infinitely divisible. Now, what do we really mean by infinitely divisible? What this means is that according to our portfolio theory, according to our model, if we need to purchase, let's say 18.7 units of a particular stock, then we will be able to do this. Now, of course, in reality, that's not possible. You can either purchase 18 units of a stock or you can purchase 19 units of a stock. You can't purchase 18.7 because the minimum unit is 1. So the assets are not infinitely divisible in reality. Then unlimited short selling is permissible. Now again, short selling is not something that is allowed everywhere in the world. Most of the developing economies do not allow short selling or only allow a limited amount of short selling with a lot of restrictions. Now, all assets are marketable or liquid. Of course, we know, having done so many different subjects, especially alternative investments, that this is not really true. Not every single asset could be marketable or liquid. Then investors are price takers whose individual buy and sell transactions do not affect the price. Now, this assumption by and large is true. So typically an individual cannot move the entire market. So generally you would take the market that is available you take the price that is available in the market. So this assumption is something that does hold true in reality to a large extent. Then investors' utility functions are based solely on the expected portfolio return and risk. Why do we do this? Because in portfolio theory, all the graphs, all the space that we are working with would have only two things, and that is your return and risk. So we work only in this space. The way we define risk will keep on changing within portfolio theory, but we will still take risk on one of the axes. Finally, the only concern among investors are risk and return over a single period. So it's a single period model, and this single period is same for all the investors. Now, after seeing all of these assumptions, you must be wondering that why do we give so much importance to the capital asset pricing model when they have such unrealistic assumptions? Now, what you have to understand is that the capital asset pricing model, your CAPM, is not your ending point. This is only your starting point. It is something that we call as a single factor model. There are many multi-factor models that have been developed which took the CAPM as the base. So this was only the starting point of it. There are many, many more models which are based on the CAPM. They've added many more factors over the years to the base model. So this is only the starting point. So you don't really use this as it is in reality. You add many more factors in addition to what the CAPM model would actually take. Okay, so that was basically your assumptions for the capital asset pricing model. Now let's go on to the calculation aspect. Now this is your main formula, and this is in the family of what we call the 4 a.m. formulas. Even if you were to be woken up at 4 a.m. in the morning, you must remember this formula. You would be doing this if you're taking the CFA exam. You would be doing this probably 7 to 8 times in your level 1, 5 to 6 times in your level 2, and equal number of times in your level 3 exam as well. So it is that important. You keep using CAPM again and again. So you cannot do any of the finance exams without remembering the CAPM formula, right? So this is essential. You need to remember this. You need to memorize this formula. All right, now let's understand what this formula says. The expected return on I is the stock that we are assuming. So whatever stock we are trying to analyze, how do we forecast the return for that? We take the base return as the risk-free rate. Now that should be quite intuitive. If we are investing in a risky asset, we will need at least the risk-free rate of return at the bare minimum, right? We should get something more than that, but that should be the baseline. Any return less than the risk-free rate should not be acceptable to us because we are investing in a risky asset. To the risk-free rate, we add this particular term, the beta that we've just calculated, times expected return on the market minus the risk-free rate. Now this part, the ERM minus RF, this is what we call as the equity risk premium or the market risk premium. So this is what you're expecting to get on the market index. So for instance, the S&P 500, if we use that as a proxy, minus the risk-free rate. So the rate which you would be getting on a treasury bond, right? Any government bond. So this is what you're getting for investing in something that is risky. So that is the premium over the risk-free rate. So either call it MRP, which is the market risk premium, or you call it the equity risk premium. And you multiply that with the multiplier that we just saw, that is the beta. So RF plus beta times ERM minus RF, that is the expected return on the asset or on the stock. So as we said, this is an essential formula. You must remember this. Now, just one point before we move on to the example is that you have to be very careful about this formula. Sometimes in the exam, what happens is that the question will provide you the risk-free rate as well as the market risk premium. So you have to keep that in mind. If they give you market risk premium, do not subtract the risk-free rate again. So the risk-free rate that has been given so that you're able to use it here. If they give you expected return on the market, then we can calculate using ERM minus RF. But if they give you the market risk premium or the equity risk premium directly, then just multiply that with beta. Do not subtract the risk-free rate again. So that's a common mistake that people end up doing. So pay attention to what has been given in the question. Have you been given the ERM and RF separately, or have you been given the market risk premium? Now let's try out a question. So we need to calculate the expected return for a security. Risk-free rate, which we denote using RF, is 5%. The standard deviation of security is 40%. The security correlation with the market. Security correlation with the market means the correlation that we have been looking at, the correlation between I and M. That is 0.8. The standard deviation of the market is 20% and the RM is 10%. Now we know that we need to apply the CAPM formula. What we need to now understand is, have we been given all the inputs to the CAPM formula or not? Now for CAPM, what do we need? We need the RF that is given to us. We need the beta. Has the beta been given? So we can see that that beta is something that is missing. So we need to use that. So we need to calculate that. So the first thing that we will do is we calculate the beta. Then we need RM, the expected return on the market. That is also something that is given, that is at 10%. So the only missing piece of the puzzle for us in order to go ahead and calculate the expected return using the CAPM model is the beta. So let's calculate that. Now how will we do this? We again use the same formula, the second version of the formula that we saw earlier. We have the correlation, that is the first thing that we need. We have the standard deviation of the security, and we have the standard deviation of the market. Those are the three things that we require to calculate the beta. That's the formula, if you remember. We take the correlation, that is 0.8. We multiply that with the standard deviation of the asset, that is 40%. And we divide that by the standard deviation of the market, that is 20%. So 0.8 into 40% divided by the standard deviation of the market, that is 20%. So that's what your beta is going to be. Now, once you have that beta, what will you do? You will apply it into the CAPM model. What is the CAPM model? We start with the risk-free rate. Remember, so you have RF plus you have beta times RM minus the RF. RF is 5%, so we put 5% here in RF. Beta we've just calculated, so we'll put it here. And RM minus RF is 10% minus this 5%, so that goes here. That is your market risk premium. So the beta comes out to be 1.6. So 1.6 is essentially the multiplier. That means that if the market was to go up by 10%, our stock goes up by 1.6 times of that 10%. So that means 16%. So we use this beta in the CAPM model. So we have 5%, which is our risk-free rate, plus the beta times RM minus RF. So 10 minus 5% into 1.6. And that gives us the expected return of 13%. So that's how we use the CAPM formula. So you need to memorize this formula. As we just mentioned, this is extremely important in finance. So I hope now we're clear with beta and CAPM.